Hi there everyone, we're back again with another banger. Yes sir guys, the most requested and demanded video guys. You know how it is, FxGoats your mentor. For those who actually don't know what this is actually the last video of FxGoats 1.0 free course. For those who have missed the previous videos, make sure you check them out. We have the first lesson, which is this one, and the second lesson is this one, and now this is the last one. In this lesson guys, we make sure that we keep the best for last guys, because we do understand that in order for you to basically understand this last lesson, you must first go through the first one, the second one, to use what we're gonna give you in this last lesson. In this last lesson, FxGoats 1.0 free course, we are giving you guys our strategies guys. Finally, that will be the end of our free giveaway to the community guys, because we do understand that most people, especially our loyal subscribers, they come from disadvantaged backgrounds guys. So that's what we saw, because we also came from the disadvantaged backgrounds. The difference between this 1.0 free course and our current 2.0 advanced course is that besides it being advanced, it also comes with mentorship, daily trading, Twitter moderation, and basically overall team success guys. We have a community whereby we trade with you guys on a daily basis. Okay, so for those who love and appreciate our content, it would be a major appreciation if you guys just hit the like button, subscribe button, and share the video guys. Without any further of time, let's get it.
This is FxGoats your mentor, and I want to congratulate you to actually making it to the first part of our last lesson. So in this lesson, we're going to cover the FxGoats new market strategy, and we call it the key to financial freedom. Reason being is, when properly applied, it will enable you to become a self-sufficient trader. So without wasting any further time, let's jump in. So the final step to understanding the new market strategy is that it's a 3-month project. We have worked on a high quality online course accessible from anywhere in the world, right? It's a fully structured online trading academy created to prepare you mentally and knowledgeably to become a skilled professional trader like us. So the previous lessons on trends, support and resistance, candlesticks, and overall technical analysis, all 4 have prepared you to now be able to understand our new market strategy. So if there's some topics you haven't fully grasped, you'll be able to recap and also learn on your own pace from your own comfortable space. So the new market strategy package comes with 2 PDFs of the new market strategy. They'll be found under the test with the user guide on how to access them, right? They are basically a recap on the final lesson of the new market strategy, and after you have gone through all 6 lessons, you can go and check them out. So we understand that we've taught you how to draw your support and resistance. So we're going to first start with a small recap of how to draw our support and resistance. As you can see, we have a support at the bottom, we have a resistance at the top, and the market will be consolidating like so. So now that you're here, you don't understand whether the market will actually break through or the market will reverse. So we've worked out a couple of ways to help you be able to spot the reversals and breakthrough. So we're going to first start with how to spot the reversal as support and resistance. So let's start. So you're going to need to see a power move into the market structure. You need to see a strong price rejection. The larger the candlestick, the better. So let me show you what I mean in the normal market. So we have this nice pair here under our support and resistance. So I'm going to help you know how to spot the reversals following our simple rules. So firstly, we can see that we're the push to the upside and we're experiencing some selling pressure here, making this a potential resistance. So the market came back down to test our support, short back up, giving us what we call a rejection, and short back up once again. So for us to be able to spot this reversal here, we basically followed our simple rules. So firstly, you can see where the power moved towards our market structure. We can see that we're at a big wick creation, and lastly we have what we call a price rejection. So a price rejection is normally a wick that is like this, like a shooting star. So we're seeing that the sellers are now in control and are going to push the market down, hence it's going to be a reversal, and that's how we spot it. So let's go over some few examples to help you know to spot this reversal. So now we have this pair here again, XAUUSD, which stands for gold. What happened was the market pushed up, giving us this push to the upside, and we're experiencing some selling pressure, making this a potential resistance. So the market came back down to test our support structure and shot back up again, creating that power move towards our key level structure. We can see where the big wick creation, and we can see some price rejection, hence we went for what we call a sell. So let's go over one more time and see another pair. As you can see here, we have this nice pair Euro USD, and what happened was the market pushed down towards our support structure, and we see it by a power move towards this level, and we can see a strong wick creation and also a price rejection. Hence the market pushed back up. Similarly, it pushed back up again with a strong power move, giving us a big wick creation and also a price rejection, and the market pushed downwards after that. So that's how you spot our reversal setups. So now let's go over to our next lesson. So now we're going to cover how to spot a breakout. So we're going to first need to go and recap on our support and resistance structures to know how to spot this nice breakout. So usually we're going to have a consolidation under our support and resistance, and when the market goes up, create some sort of consolidation, we are seeing this as what we call preparation for a breakout. The reason we're saying this, we are seeing that we have created what we call higher lows. So these higher lows act as a pressure from buyers to actually push the market, giving it enough strength to actually break through our market structure. Hence we're seeing this as a breakout and not a reversal. So let me show you how we can spot it in an actual market. So what we're going to need first, we're going to need to see higher lows into resistance, we're going to need to see lower highs into support. It needs to be a build up, creating that buying pressure or selling pressure to actually break through our market structure. So now let's see it in an actual market. So we have this nice pair here, GBP USD, and what happened was we can see that we had what we call some nice lower highs. So these nice lower highs were acting as selling pressure. So we're seeing that the sellers are now in control and are pushing towards this support structure, gaining enough momentum to actually break this level here. And that's simply how we spot a breakthrough. So now let's go over a few more examples. As you can see here, we have used DCAD. So what happened here? When we spot a breakout, we need to see what we call a build-up. So this is what we call a nice higher lows. So we see we have here higher lows and they're building up enough momentum to actually break through this support structure, which is opposite to reversals, because for reversal we need to see a power move towards a market structure, and that's how we get those price rejections, which is a reversal, and you've learned how to spot that now. So let's go over to a few more examples. So we have this nice pair here, EURUSD, and you can see it has been creating lower highs. So these highs were acting as selling pressure towards our support structure, giving it enough momentum to actually break through. So let's go over our last example. As you can see, we have what we call here a nice build up. We're gaining what we call selling pressure to actually get all the strength to push down over our support structure and making it an actual sell. So for us to have a reversal, we need to see a power move towards our support structure followed by a reversal. We have a power move making it a price rejection, and that's how we spot a reversal, and this is how we spot a breakthrough. So let's now recap on how to spot a reversal and a breakout. So we're going to need to see a power move into the market structure. You need to see a strong price rejection. The larger the candlestick, the better. For a breakout, we need to see high lows into resistance. We need to see lower highs into support, and we need to see a build up acting as consolidation. So that's creating buying pressure or selling pressure to give it enough momentum to actually break through our market structures. So that's what we use to identify a breakout or reversal. So core of price action trading is support and resistance. So support and resistance levels is the most important concept in trading you will ever need to learn to master as a professional or a full-time trader. So drawing these levels perfectly and neatly with minimum error is very crucial for trading success. The ability to draw these levels professionally is a difference between a successful and an unsuccessful trader. So it's important for you guys to draw these levels perfectly, otherwise you will not be able to trade successfully. So winning and losing traders both draw these levels, but the thing that separates winners from losers is that the right selection and the drawing of support and resistance levels for trading. Hence, it's important for you guys to know how to properly draw your support and resistance. So now we're going to cover the new market strategy, exposing the new market, right? This book is written for intermediate and advanced traders. So if you're an absolute beginner, we recommend you go over our beginner lessons first to take full advantage of this book. So market makers, we're going to cover market makers in detail in the next lesson. For now, what you can know is that market makers are people who actually move the market. Not only that, they have access to all the patterns and information that is shared to 95% of traders worldwide. Now they have learned how to use this information against you, as brokers have sent all the information about how 95% of traders actually trade. So what we want to do is we want to eliminate you from those 95% of traders and be part of the 5% that actually wins. Now, as you can see, our main focus on this new market strategy will be support and resistance, because knowing how to properly use your tools will enable you to spot traps that are set by the market maker. As you can see, it's important for you to know how to properly identify these levels, as it can help you identify your low and the high of the day. So we're going to analyze using an hour, 4 hour to daily charts. So you're going to analyze with the 15 minutes chart for your fundamentals trading, and that is of course news trading. So now we're going to go over a few examples and see how we can spot these nice traps. So firstly, we're going to start with this nice pair here, USD CAD. So if you look closely here, what 95% of traders will do, they are seeing this as a nice cross of what we call our trend from this bullish trend and would go with a sell. However, what we discussed that it's important for you to properly draw your trend lines, because you want to cater for most touches. As if you look closely, we can see this as simply just a bounce on our trend line, right? So what we are doing, we're catering for this touch here and this touch as well. Hence we're seeing this is simply just a bounce on our trend. So it's also important to know how to draw your support structure, as we're also seeing this as our bounce of our support. So our support structure is basically at 1.3379. So we want to go with the buy here, and 95% of traders went with the sell. And let's see how the market now responds. As you can see, the market responded by actually making a fake out. So it's important for you to know how to use your tools, as they can help you identify such traps. So now let's continue. So now looking at this pair here, what most traders did, they're seeing this as what we call a breakout and would want to go for a sell here. So what we see here, we're seeing our reversal setup. That is basically a power move towards our market structure. We're seeing a big wick creation, and now we're seeing a nice price rejection simply by just retesting this nice support structure here. The reason being is knowing how to properly use your tools will enable you to see such traps, as it's also important to know how to actually properly put your support structures to identify such traps. So now let's see how the market responded, because 75% went with the sell and we went with the buy. So as you can see, we are seeing a nice retest. Like again, it's a price rejection. And to note again, for you to hold a pair like this for swinging, it's important for you to draw your trend line correctly, as it can help you know how to actually hold your trade. So if you draw a trend line, I'm going to put my line here for it to be more accurately. So it's important for you to know that you can actually lose 1 and gain a potential 6 by following our simple rules. So the market tends to follow the trend 4 out of 5 times. So knowing to properly draw your trend lines, it's important for you to spot traps and know how to swing your trades. So now we can continue, right? So if you look at this pair here again, what most traders saw, they saw what we call a nice head and shoulder. We are saying this is incorrect. We're seeing it as just simply a retest on our resistance, because for it to be a nice head and shoulder, it should be a breakout outside our trend. So let me show you what I mean by that. So let's say now we're in a bearish channel and the market is ranging like so, right? So the market will be inside this bearish trend and being consolidating like it's doing now. So for us to spot a head and shoulder, it should be a bounce outside resistance and giving us a retest. So that's how we're supposed to enter a head and shoulder. It should be outside our trend and giving us a retest entry, and that's how we properly use our head and shoulder. So most traders use their tools incorrectly and want to force their ideas into the market. As you can see, we're seeing this as an invalid head and shoulder. So 95% went with the buy and we went with the sell, and let's see how the market responded. As you can see, the market shot back down once again. It's important to know to properly use your tools, as it's just only a retest on our resistance and not a breakout. So just like that, we are done with this lesson.
Hi there, FxGoats here. This is part 2 of exposing the new market strategy. So basically, you're in your final chapter into becoming a professional trader. So this is a very important lesson, and without any further waste of time, let's get started. Firstly, let's start with the overview. What you'll be taught in the next few lessons will change everything you've thought about Forex and how the market really works. We will go over market structure and patterns that the dealers use to entice traders into the market. We will also be going over how to enter the market against the retail trading head and in line with forex dealers and bracket market makers. So what I mean here is, I'm going to teach you to become part of the 5% that actually wins in forex trading. How? By not forcing your directions into the market. So basically, I want to turn you into a trend follower. I want you to follow the direction given to you by the market. Hence, I'm saying trading in line with the forex dealers. Let me show you an example of what I mean by that. In forex, we buy low, we sell high. So with those two words, let me show you what I mean. So let's say we have two types of trends. We have a downtrend. Secondly, we have an uptrend, right? So what I taught you in the previous lessons is that every time we have a resistance, we're looking for selling opportunities. And every time we have a support, we're looking for buying opportunities. Many people ask themselves, why do we buy low? Why do we sell high? So every time we have a high in a downward trend, we're looking for sells. So meaning every time we're looking for what? Higher lows. Every high is lower than the other, hence we call it higher lows. And here we're looking for what? Lower highs. Every lower is higher than the other, hence lower highs. So we buy low, we sell high. That is the basic meaning of forex. How do we get our buy low or sell high? We get our buy low or sell high. In a downward trend, we're looking for high selling, and in upward trend, looking for what? Low buying. So that's basically how to make sure you follow a trend and you don't force a direction. I'm not forcing a direction here. I'm entering this buy here because the trend is saying that every time it touches this point, it's going to a buy. Hence, I'm saying I'm seeing the direction provided to me by the market. Every time here I have a high, I'm looking for selling opportunities. Why? Because every time it hits it, the market tells me that it's looking for a sell. Hence, I'm saying I'm following the market and not leading it. Okay? So let's continue with our lesson. Now, what is the benefit of trading in line with the dealer? Once the dealer makes his move, the market can swing hundreds of pips, and if you're trading in line with the dealer, you'll have much higher potential for profit in a very short period of time. As I showed you in the previous example, every time we have a sell, we make sure that we enter that seller up until its end. And every time we have a buy, we enter that buy up until its end. Hence, I'm saying a higher potential for profit in a very short period of time. We'll also be going over trading psychology and patience, how to obtain trades with up to 1:10 or even 1:20 risk-reward ratios with little to no drawdown. Don't think this is possible? You'll be very surprised with what you'll learn in the next few lessons. Prepare to enter a new paradigm. So basically, this is just our introduction. Now let's go to the next lesson. Now, let's start with the real deal. Lesson 1, the market makers. Before we start with this lesson, I want to tell you something about the market makers. The market makers took into account to study their enemy, in this case me and you, the retail traders. The market makers made sure that they find a weakness into the retail traders and they exploit that weakness over and over again. Hence you see that the overall market grew from 3 trillion into 5.5. Now I want to show you how the market makers exploit weaknesses. The forex market is controlled through brokers, hedge funds, and banks with the highest market share percentage. Did you see right there? The market makers is controlled through brokers, hedge funds, etc. So, which means the market maker is the real enemy. We have brokers right here, and we have us. The brokers are our enemy because they don't have our best interest at heart. But the major enemy is the market maker. Why? Because they're using the brokers as a front to get to you. They control the market. Now I want to show you how to understand the market makers, how to see how they trap you. Okay? So let me show you how they trap retail traders. You are of no value to the dealer, the market maker, if he cannot get you into the market. Now, this is the type of traps they set for retail traders, okay? Once the majority of the retail traders recognize the pattern that is presented on the chart, the market maker will then either show the retail traders a bit of profit to entice them to use higher risk, leverage more, and overtrade. Then once you, the retail trader, are in over your head in trades with risk at max, the dealer shifts the market completely against you and hits your stop loss before you know how to react. You see what I did there? He put you where exactly he wants you to be, and immediately you fall for his traps, he turned the tables on you. Has this ever happened to you before? Thought you were in a perfect trade, thought nothing could go wrong. The perfect trade setup was in progress, a great entry, your first position is in profit, you add more positions, then suddenly the market swings in the opposite direction, leaving you panicking and blowing account after account. What you see here is that the retail traders are extremely predictable because they see this 5.5 trillion a day as some type of a magical get rich quick, a given tree, of which that's where the market makers exploit you. They see that you always want to risk big. You always come to forex trading as if it owes you money. But as you can see right here, this 5.5, it is a given tree. But how do you cut off a big tree? You don't cut off a big tree by just one swing. No, you cut off a big tree by hitting the same part over and over again consistently until it breaks. Hence, I'm teaching my people to use proper risk management and win consistently. So overall, you're going to drop the big tree. So now that you know that the market maker are able to turn the tables on you, you're asking yourself, how are they able to get the power to turn the tables on you? Now in this next lesson, I want to show you how the market makers are able to get the power to turn the tables on you. Okay, the dealers. The dealer has many names: market maker, liquidity provider, smart money, etc. So when do these market makers actually make the markets? So the market makers are mostly active during the London and the New York session. During the Asian session, the market makers will be replaced with what is known as a liquidity-sensitive automated market maker that will move the market sideways in a perpetual consolidation for about 8 to 10 hours. What I mean right here is the market maker will create what is so-called mid-range zones. So the market is going up and down right here with no overall direction, hence building a momentum for the market. This is normally done during the Asian session. Short 10-hour consolidation phase is an absolute key for the London and New York dealers. This phase gives the dealers an added amount of liquidity that is needed to move the market when the dealers are ready to do so. Okay, so now during the New York and the London session, during these times the market will move much faster. You will many times see that once the Asian consolidation is over and the London session begins, the market may move in one direction for an entire length of the London session, and then coming into the New York session completely reverse and go into the opposite direction of the London session. If you trade the London and the New York sessions, you know this is true. Many times one session is used to fake out or give a false directional bias to retail traders, then the session changes over and complete reversal happens. Now let's say, for instance, we're in a consolidation right here. Once you enter your New York session, is that the market will go up. The session changes, goes now to the London session, immediately we see a strong drop and the direction is now created. We're now in a downward trend. Can you hold a downward trend by here? No. Automatically, you blow your account with just this first move here. So the market makers always give you these fake outs to make sure that people fall for them and then blow accounts because they never set stop losses and they always risk big. Why? Because when they give you what you want to see, you go all out. I'll be teaching you how to avoid such things, okay? Now let's continue. Manipulations. Now that you know the market makers are setting traps for you and you know where do they get the momentum, I want to teach you how do they start the manipulations, okay? So, to understand how the market is manipulated, let's forget everything we were ever taught as a retail trader about technical analysis. If it were really that easy, why do 95% of all traders fail? Why does the average trader using the mainstream form of technical analysis blow his account within the first 3 months of trading? Why is it that most traders using technical analysis take 10 plus years to become profitable? Why? Because they don't know that the problem lies inside. Trading is much more than just finding patterns. On the outside, trading is watching charts, spotting fake outs, trap zones, consolidation, etc. That is just the easy part. But what you can see, which is the hardest to overcome, is what's inside of you, emotions. Can you mentally handle a drawdown? Are you confident in your trades? Are you taking trades because of an impulsive emotional response, or do you let the trade come to you? Let me introduce you to something called patience. Now let's continue. There is time to trade and there is time to rest. If you don't know when the market makes its move, you could be waiting hours before you really see the type of volatility in the market that you're waiting for.
Okay guys, so this is lesson 3, the market structure. Now, before we start this lesson, I want to tell you important words. How do you become a professional trader? Many people don't understand this. It's not about how many trades you win, how many trades you lose. Rather, it's about how much you lose when you are wrong and how much you win when you are right. But that is, I'm going to teach you to know that every time you are wrong, you get out quickly. But every time you are right, you keep on putting stop losses above profits. Your winners get more and more and more. Hence, I'm saying the market is designed to make sure that you must close your profits quicker and let your losses run. So I'm going to make sure that you close your losses quicker and you let your profits run, okay? But how? Understanding the market structure of the market. So let's get started. You will see variations of structures on every graph on every currency pair. This is the fundamental framework on which the market is designed. The consolidation phase is set up to keep traders jammed up in the same price range with very little movement for extended periods of time, thus creating a state of fear and panic in retail traders' mind, forcing the weak out of their positions. Let's continue. Currency prices may seem to move randomly, but they often exhibit repeatable patterns. When we see these patterns, we can anticipate the direction of prices with a high degree of mobility. Like I showed in the beginning, there's three types of trends. We have a straight trend, we have an uprising trend, and we have a downrising trend. And in those trends, you must understand what you're looking for. In a consolidation, you're scalping or you don't trade. Every time we have a downward trend, you're looking for selling opportunities every time we have higher lows. And when we have an upward trend, you're looking for buy opportunities when we have lower highs consistently so. Now, how to win when you have a downward trend or an upward trend? Okay, let's understand this first. Market prices tend to move in trends, like a way water moves waves. Some waves are smaller, some waves are bigger, but the guarantee of a wave occurring is certain. That is very true, meaning when you're in a downtrend, you don't know when you have a sell, but you know that a sell is coming. Why? Because it's a downward trend. You must first wait for a high and then enter the trend, okay? Let's look at this example I've given you down here. First of all, what did I teach about a downward trend? It's better to have a zone than a resistance line, okay? Now let's say we have a resistance zone here and we have a resistance line. Now let's spot where the market makers fooled people, where they had fake outs, okay? This is where they hooked up buyers and people lost money here because they entered a buy entry and overall sell. And then here, the market makers what? Made people to enter a sell. And then what? Went to an overall buy. So, I taught you all of these things and you must be careful of all of them. Okay? So now, let's start this thing clearer again. We have our zones here. Okay? Every time we have a high, we're looking for what? Selling opportunities. Every time we have a high, we're looking for selling opportunities. Even lows in a downward trend, you can still went for a buy if you want to. But I don't recommend entering an upward trend on an overall sell. You're doing this only to scalp. But in overall, you must keep this one as a sell. Okay? And then as you can see right here, we finally bounced off on our support. So meaning the trend is about to change. Why? Because of a double bottom confirmation. A double bottom tends to us that the market is about to change. Or we have a reverse head and shoulder. These two right here shows us a change of direction. So yeah, now let's continue. As you can see right here, we say we're looking for a buy. Why? Because we entered what now? We entered a buy trend. And we're looking for those ups and downs into a buy trend. Alright? As you can see right here, the market respected setup. Why? Because you understand the patterns. Let's go to the last lesson, reversals. Okay guys, this is lesson 5, the reversal formations. Okay, remember when I promised to teach you how to catch trades with up to 1:10 or if 1:20 risk reward ratio with little to no drawdown? This is that lesson. This is the last forex strategy you will ever need. Why? The double tops or bottoms are common reversal signs. Now, before going off to the charts and start trading every MNWC, let's go over some characteristics of these patterns and why they happen, okay? Let's start here. What can you see right here? Okay, let's say we have an uprising trend right here. What do we see? We're seeing a reversal. Reversal is spotted by what? It's normally spotted by, and then our M will obviously occur like this. So this is our M right here. We're looking for what? We're looking for sell. Let's get started. So we've seen that we form an M here. So let's see what happens. Okay. Market makers need to make traders believe that trend will continue. So they will often spike to or past the high very fast with one large candle. Okay. I did teach you about this, about breakages and reversals. Every time we have a reversal, you always spot these things right here. We have an evening star, and then we have a bearish engulfing. Okay. How do you spot an evening star? A reversal candle. How do you spot a bearish engulfing? We firstly have a bearish candle, and here we have what? We have two bullish candles. These are two confirmations of reversal in terms of pairwise. Okay. Above, you can see the formation of the M. This is what you will be looking for when trading. This pattern is the retail trader trap that the market maker said, and here is how it works. Okay. So every time you have this, they want to make sure that they hook up what? They hook up buyers. Why? Because in overall sell, many people use this as just a resistance. They say, oh, it broke my resistance, I'm looking for buying entries, and that's how they always lose. It's a trap that I want you to practice over and over again until you master, because once you master this, you are now confirmed to be a professional trader. Okay, these M and W formations are found throughout all time frames. The time frames does not change the pattern, because the pattern is based off the fear and greed instincts of all human beings. You could even say that the pattern is not due to the chaotic series of transactions, but due to how all humans react to fear and greed. What market makers want retailers to see? You see, they always want you to see what? A breakage of your resistance, to think this is an overall buy. And then the dealer, the market maker, will break past the previous established high. Let's say maybe we had a high here. It will break past this high, also creating an information make it look like the price will continue an uptrend. Like we say right here, you would think it's a continuation of an uptrend. This is what really happens. What really happens immediately after that high, it drops. Now the dealer closes above the high, then instantly drops back below the high, trapping buyers at a second leg of the M. And we've seen this many times, guys. I want you to make sure that you can never have this. And if this happens to you, you have a stop loss. You don't lose. Okay? Now let's continue. Now that we have seen their main pattern, we have to interpret the variations of the patterns, because the dealer is never going to give the exact same pattern every time. Now we have a bearish engulfing right here. Every time it breaks your high, it's a trap to hook you up, and you can see right here this week comes back strongly, making sure that you lose all your money. Okay, this is a smaller M inside a larger M at a higher of the day, meaning the higher of the day is spotted by the next M. This is the high of the day. You enter for what? You go for a sell. And then let's say we have the second day here, a higher day for a second day, we enter for a sell. And you can see this also in an overall week, that we have a high of the day here in a weekly. That's when you also enter for a sell. Now let's go to the W's now, a reversal of sell going to a buy. Okay, now W formations at the low of the day, London session, we have a consolidation right here, and every time they hooked up buyers here and it turned down out of it, and then as you can see right here, is now creating a different trap. Now it's creating a W, grabbing what here now? It's grabbing what? Is grabbing the sellers into a buy trend. So we've seen this too many times. Every time you see that, you just put your stop loss if you're wrong. If you're right, you enter into a buy, you let go up. What you do is every time you're in a buy stream, you just have to make sure you put your stop loss above entry, making the market maker pay. Now let's go to the last example I want to show you. Now we have different types of legs. Low of the day of the previous day, now low of the second day. You see? But why? It is still a W. You're looking for what? You're looking for a buy movement. I'm pretty sure you've noticed them now way enough that every time we have a strong push to the downside, we see what? A strong rejection. A rejection of that movement giving us a strong buy. These are all obvious moves of the market makers, and that's how they trap the buyers, and that's how they trap the sellers. You have to make sure that you study this thing. Forex trading is a skill that can set you off for life. Now, I need you guys to make sure that you practice over and over again until it becomes easier. That's all from me, FxGoats, signing out.